Hello and welcome to Lunch with Sibos. I'm Chia.
And I'm Nadine Dereza. In a packed programme, we'll be talking payments and cybersecurity with the Chief Executive, Americas and UK region for SWIFT, Javier Perez Tasso.
Oramas Adamavicius, President of DevRich, will be giving us his insights into the barriers and benefits of digital transformation.
And we'll also be asking Umar Farouk from JP Morgan how banks can use technology to create a competitive edge.
In the Sibos Game Changer, we'll be hearing about the impact of President Trump on regulation.
But we kick off with a look at ways to combat financial crime.
Well, banks file millions of suspicious transaction reports every year.
Yes, it's estimated that less than 1% of criminal funds flowing through the international financial system are confiscated by law enforcement agencies.
And here to tell us about the new partnerships being forged to combat this, we have Jen Calvary, Global Head of Financial Crime Threat Mitigation at HSBC.
And we also have the head of the Future of Financial Intelligence Sharing Programme, Nick Maxwell. Welcome to the programme.
Welcome to the show. Nick, start off with you. We know there's been a lot of effort to try and stop money laundering and financial crime, but is it really working?
So our research study really looks into this issue of effectiveness. And there are huge challenges in the system. You know, as you said in your introduction, our research found that 80 to 90% typically of these suspicious activity reports are not providing value to active law enforcement investigations. So that's a real challenge. These are the ultimate users of the information. They need that intelligence to disrupt financial crime, and the quality of the reporting isn't there. And the volume of the reporting is so vast that it's like finding a needle in a haystack. So our research reports, working with HSBC, as well as EY and Thomson Reuters, and a number of other global banks, have been looking into public-private partnerships and the potential that those partnerships have to provide a much higher level of dialogue on threats and risks, and ultimately improving the timeliness and the impact of suspicious reporting.
Now, Jen, if I can bring you in. Before you joined HSBC, I was looking at your biog, and I know you've been fighting crime with the Treasury and Department of Justice in the United States of America. So how important is it for banks to share information?
It's incredibly important. It is the whole reason that we have the regulatory regime. So the purpose of the anti-money laundering regulatory regime is for banks to help protect the integrity of the financial system, keep criminals out of banks, and to provide information that's useful to law enforcement. And I can say from being on that side that the information we get from banks when I was wearing that hat was some of the most important information we use to track down money, to take away the profit motive from criminals, to understand who was part of a criminal organization by looking at who had the money. So, you know, I think the public sector truly needs help from industry.
Well, Nick, I'm going to ask you about that because you publish a study, the role of financial information sharing partnerships in the disruption of crime. Can you tell us some of the key findings from that?
Yeah, absolutely. So this is a very exciting area of policy and practice. A lot of countries are experimenting, innovating in how they bring together major financial reporting institutions together with law enforcement agencies. So we look at the different ways in which those partnerships have been constructed. And ultimately we find that although some of them have only been established for a number of months, already the impact in terms of the quality and the timeliness of reporting is significant. And the performance in terms of supporting arrests and asset recovery of criminal funds is impressive. However, it's early days, and these models are in their infancy. What we are looking for in the future is how they could be scaled up. So they're only able to process a small number of cases really per month and through the year. So we're looking at the role of technology to enhance the scale and impact of these partnerships.
And Nick, what are the barriers when it comes to preventing information sharing?
So enabling this type of sharing requires legislative clarity. That's absolutely key. And only in 4 countries do banks like HSBC and others have the legal ability to be in an information exchange with law enforcement agencies about entities of concern. So this will be law enforcement providing a very clear direction on their priorities and what they need in terms of information to support investigations. Banks then have their regulatory responsibilities, but they have a huge amount of data and skills and expertise to be able to support that law enforcement investigation. There's very few countries in the world where that enabling legislation exists, and we're going to FATF, the Financial Action Task Force Forum of Governments, to talk about how more countries could establish the legislation needed to enable this sharing.
And that rule of law is so important, isn't it? Without it, you don't have the teeth.
Absolutely, and we did a number of workshops all around the world, and what we find is that historically, good investigators from law enforcement and great analysts from the private sector have had to rely on personal relationships in order to progress investigations. So really this is about creating systems and procedures that are accountable, that are transparent, and that provide all sides with the regulatory and legal comfort to engage in this sharing.
So the information sharing really is vital here. Jen, let me ask you, what's already being done to strengthen that?
So HSBC, along with many other financial institutions, we're participating in some of these public-private partnerships. For us, we're participating in partnerships in the United Kingdom, in the US, here in Canada, where we are today, in Hong Kong, in Singapore, in Australia. We're talking to colleagues in many more countries, including in the Latin American region, about creating such partnerships as well. And we're really seeing the progress. So it's not a situation where we so often feel at a bank that we're making reports and we're not sure that they're actually useful. Perhaps we're not providing useful information. Perhaps there's not the resources to follow up on it. In these partnerships, law enforcement tells us what's important to them, what they want us to focus on. They have information we don't that they can share with us, and then we can share information with them that they don't have. And we are seeing results from these partnerships just in Hong Kong, which has only been up for 4 months now, so a very short amount of time. Already there's over 60 arrests and about $2 million in Hong Kong dollars in seizures. So in a very short time, some big results, and we're seeing similar results across the other partnerships.
And in terms of the countries that you mentioned, you said 4, so which countries are sharing information at the moment?
So in our study, we look at 6 countries. Canada, the US, Hong Kong, Singapore, the UK, and Australia. So only in 4 countries have they established partnerships where they can share information about suspects. They're able to respond to big events like terror incidents and have a rapid sharing of information about entities or companies of concern. So that happens in the UK, the US, Australia, and Hong Kong. The legislative environment is slightly different across the different countries, and that's one of the things we'll be talking to the FATF Forum of Governments about. But also in Canada and Singapore, where the legislation doesn't allow for sharing about entities, which is tremendously helpful for investigations, there's still a very rich dialogue on typologies, on indicators, and on the character of the crime that the private sector is seeing, that the public sector is seeing, and bringing those pictures together to inform a wider understanding of risk.
Well, I'm from Singapore, so and I can see how vital this would be. But Jen, perhaps you can share with us, going forward, these sort of international partnerships, what kind of impact are we really looking to achieve?
I think what we're looking to achieve is opening the dialogue around trying to understand the effectiveness of the various techniques that we use to manage financial crime risk and to aid law enforcement in their pursuit for money laundering and terrorist finance. So let's look at the various techniques and what the actual outcomes are. And so let's compare public-private partnership and some things we might do there compared to things we had been doing in the past. Let's continue to look at technology. Law enforcement is still certainly, and what I imagine always will be, in a place where they're looking for financial institutions to tell them where we might see the criminal activity, not just what they already know and getting more information, but where do we see criminal activity that they may not know about. And that's where there's a real role for technology and innovation in this space. So much of the dialogue that's going on here at Sibos about artificial intelligence and big data and data science and all the kind of technology and data science side of things that we can bring to bear on this problem are really something that we're looking to encourage.
Now, just on that note about partnership, what should countries or law enforcement bodies do if they want to go down that route to establish a partnership?
Well, we set out 5 different principles and then 26 recommendations in our report released today here at Sibos that provide a toolkit for governments and private sector leaders in countries where there's the appetite to move forward with this partnership, to really guide them through trust and leadership, legislation, the governance around the partnership, the technology capability around the partnership, and finally the adaptability and the onward evolution of those partnerships. And as we've seen in Singapore and Hong Kong, even when there isn't the legal gateway to share suspects of concern, information about entities, a huge amount of value can still be established at the typology level, at the understanding of the character of the crime level, bringing together the insight from the private sector together with law enforcement to have a more comprehensive understanding of risk.
So it sounds like there are quite a few levels in terms of sharing, in terms of, for the policymakers then, what, Jen perhaps can give an insight to this, which are the areas they should prioritize so that law enforcement and banks can better speak to each other?
Yeah, I think it's, first of all, enabling, having legislation and regulation that enables the public sector to talk to the private sector to talk to other parts of the private sector, so one bank to another bank, and for even a large global bank like HSBC, for us to be able to talk to ourselves. So an affiliate in Hong Kong being able to speak to an affiliate in Singapore and yet an affiliate here in Canada. So really enabling that type of information sharing. We know that money flows across borders. That's how money laundering and sanctions evasion works. And so we need to be able to see that picture across borders as well.
And Jen, just staying with you, how do you see the way that banks tackle financial crime evolving over the coming months and years?
Well, I think banks are getting much smarter, quite frankly, in the area of financial crime risk. There's just been a very large investment across the industry in this area over the last 5 years, and with that comes an increasing sophistication. And so banks who are very used to managing credit risk and really being innovative and constantly pushing the envelope to get better at evaluating credit risk, now we can use those skills in the financial crime risk area and likewise seek to innovate. So I think as we look in the years ahead, I think we're at an inflection point, quite frankly, and we're going to see a very big change in how this is done and a real demand to ensure that we are effective in our outcomes.
Someone got to say inflection point. We were hoping that someone would say it.
That word.
I do.
But just one last question, because we know while we're talking about this, the bad guys, the criminals, are also looking at new ways to innovate and to try and get a hit. So it's a bit of a race. How can banks, therefore, stay ahead of the game? Nick?
Well, you're absolutely right, and obviously Jen has a huge amount of experience on that harder edge of the law enforcement picture. But criminals are constantly adapting to try and evade detection. And of course, they operate seamlessly across borders, and they cooperate across organized crime groups. So the challenge is vast when most of our systems and our regulatory and legal systems are based at the national level. And these partnerships that we look at in our study are at the national level. So there's still a long way to go to enable the kind of cross-border information sharing and the real-time disruption and understanding of the criminal threats if we're going to respond to this criminal challenge.
And Jen, just very quickly, what should governments and regulators do to improve information sharing in the future?
Well, I think just to build on what Nick said is fight a network with a network. So if criminals are cooperating across borders, we need to cooperate across borders and across organizations. If they're innovating, we need to innovate. So we need to match what they're doing and make sure that we're staying ahead of the game.
Jen and Nick, thank you very much for your time today.
Thank you.
Thank you.
After the 2007-08 financial crisis, President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act to stop history repeating itself.
Now, under the Trump administration, financial regulation is likely to change again. But the nature of the change is unknown, which creates uncertainty for banks and makes planning very difficult.
Well, earlier I spoke to Aaron Klein, fellow of the Center on Regulation and Markets at the Brookings Institution, who helped craft and secure passage of the Act, and began by asking him, what exactly is Dodd-Frank?
So Dodd-Frank is legislation that was meant to reform and fix the financial system so that we would never again have a crisis without the ability to respond. So it's really kind of two distinct parts. One is crisis prevention to improve regulation so that the financial system does not implode. And the second is crisis mitigation. Human nature is that there'll be another financial crisis. Given that, how can we create a system that's more resilient, that allows institutions in the system to experience the ups and downs endemic in finance without having the cataclysmic explosion that was the global financial crisis?
And has it been working? Has it been keeping the banking sector more stable, more secure?
So I think it's worked pretty well. I think when you look at how far along we've gone into implementing it, the system has become higher capitalized, risks and rewards are being more correlated, and a series of new tools are being put into place to allow institutions to wind down in a way that they don't threaten the kind of domino or calamity. In truth, we may not know until the next time we're actually tested, but the reforms of the Great Depression worked for many generations from the 1930s. So, nothing lasts forever.
Right.
I don't think this is the final chapter of financial regulation for human history. On the other hand, I think it's working pretty well.
So why then does Trump want to change it?
Well, what Trump wants is more economic growth, right? To that extent, he views finance as a means, not an ends, to achieving higher growth. And in that way, you can think about financial regulation a little bit like a speed limit. People want to drive faster, but when you drive faster, if you have an accident, it is a lot more dangerous. And the ramifications are a lot more severe. So right after an accident, people drive very slowly. Over time, you forget and you say, are we there yet? You have your kids in the back. Are we there yet? I want to get there faster. I want to get there faster. So in that way, Trump kind of wants to move faster. But I think people misunderstand a core point. The Trump philosophy is not regulatory or deregulatory. It's just faster growth.
Okay, so the regulation that he wants to change it to, does it?
He wants to have faster growth, and he's not quite sure how to do that. He's been told by some people that regulation is slowing growth.
Right.
And in that way, he wants faster growth. So if that means less regulation, he's for that. If somebody else tells him that what you really need is Glass-Steagall to punish the banks and jump on a populist wave, he's for that too. So it really kind of changes at any given moment. What he's really after is faster economic growth. One can debate whether or not regulation is what's slowing down economic growth or not.
Okay, so he knows the end goal, but how to get there, that's still up in the air.
Very much unclear. And what you're going to find in Washington is a paralysis among Congress because there is no consensus as to what would increase economic growth, whether financial reform or changes to Dodd-Frank would even accomplish that. So what you're going to end up having is a regulatory agenda where various financial regulators Trump puts in place roll back or slow their regulatory agendas to try and promote growth in their sector, according to their individual beliefs. It's going to be a lot more idiosyncratic than it is going to be comprehensive or holistic.
So there was a review of the Dodd-Frank in June by the Secretary of the Treasury. What were some of the key findings?
Yeah, so, it's a little bit interesting because the Treasury Department, where I worked for 4 years, has some authority under Dodd-Frank, but most of the regulatory authority are frankly in the independent regulators. So to some degree, the Treasury looked at a lot of the requests by industry, kind of said no to some of the ones that were more tangentially related or less well-grounded, and then endorsed a series of other requests to make smaller changes within the scope of Dodd-Frank. This is not a Dodd-Frank rewrite like the House of Representatives is pushing. It's more like a Dodd-Frank rollback. So it's keeping the kind of framework, but trimming the sails a little bit around the edges.
So you're in touch with many politicians and policymakers. How do they feel about all this?
There's no uniformity. There's one group that says that Dodd-Frank came down on tablets from Mount Sinai and it should never be touched, right? I'm not in that camp, but that's one. There's another group that says we never were for it to begin with. We should get rid of it entirely. It's a misdiagnosis of the cause of the financial crisis. I think that group's substantively wrong, but it exists. The American public are not where their elected representatives are. If you poll Dodd-Frank, depending on how you ask the question, it polls between 55 and 75% in support. Of those that oppose, by the way, that makes it the most popular of the main Obama legislation from his first term compared to Obamacare or the stimulus. If you ask the 25 to 45% that were unhappy with Dodd-Frank, what do you wish it had done differently? 2 to 1, they say we wish they'd been tougher on the banks. So it's only 1/3 of the American public that thinks Dodd-Frank went too far. Now, if you ask elected members of Congress, if you ask bankers, you'll get a very, very different response. So what you're seeing is a disconnect between the financial industry, which thinks Dodd-Frank by and large went too far and should be trimmed, but generally not replaced, because there are areas that got right, and the elected people, the core populace of America, which is still angry about the financial crisis, feels that the industry got off too lightly, and that profits in banking have become synonymous again. Meanwhile, lots of Americans still feel strong economic pain. So there's a populist political disconnect.
Right. And we know in Washington personnel is policy. So who supports these changes and who doesn't?
So far, what you're seeing is the Trump administration has been very slow to nominate regulators, but they're starting to get put in place. Just a couple weeks ago, the Federal Reserve finally got their first Trump nominee to be Randy Quarles, who will be the Fed governor in charge of bank regulation. There's an acting comptroller of the currency and a nominee that may be going through the Senate. So you're starting to see there's a new chairman of the SEC. That was one of the ones Trump moved faster on. You're starting to see individuals get put in place. Their agenda is first, no more regulation. They're stopping things. They're delaying things that were in track from their predecessor. And then they're starting comprehensive reviews on where to make changes. But the changes are within the broad context of Dodd-Frank. It's not a complete resale and rewrite.
So at some point, is Trump able to just repeal financial regulations? No?
No, not only is he not able, when you say not only is he not able, it's not really his call. The regulators have pretty strong structural independence in the way our system works, and things take a very long time. What you're seeing, rather than full repeal, because a lot of these regulations are required by law, and there isn't going to be a big legislative change, in large part because the legislative will isn't there. America tends to legislate about banking after a crisis. But what you're seeing is changes, modifications, narrowing of scope, changing of terms. Sometimes you're seeing the creation of loopholes. And what you're also seeing, and likely to see going forward, is no new regulation. So you're going to be in a situation whereby innovation is going to move products that are currently within a regulated space into something that's new, external to regulation, that could grow over time.
Okay, and I guess that's where the challenge is. Everyone's asking, what is the implication of these changes? What are these changes? How will they affect me? How will it affect the financial sector?
Well, I think what you're going to see is lower levels of enforcement, fewer fines, smaller dollar amounts of fines, and you're going to see broadly a situation in which some of the practical implementations of regulations that have caused pain, hopefully pain greater than the ones that are rolled back will be hopefully those whose pain exceeds their benefit. Whether or not it's simply a cost-benefit approach that's enacted, or simply the removal of more costly regulation, that remains to be seen. As an economist, I like thinking about things more in terms of relative costs and benefits, not just absolute costs or absolute benefits.
And do you think that will affect America's role on the financial regulatory front in terms of how they're perceived?
Well, I think America as a global force in financial regulation is going to be greatly diminished. I think that, Trump ran on a very clear message of America first. Whether you agree or disagree with it, his message was very clear. America needs to act more in its self-interest, not the interest of the world. That's a big change. There'd been a broad consensus among both Republicans and Democrats for generations that America has a special role in the world. We're the currency of the world. We're the military superpower of the world. We had a requirement to conduct ourselves as a global leader. And that, whether that's in our short-term best interest, it was in our long-term best interest. Trumpism disagrees with that. Trumpism argues that America needs to pursue its short-term own interests, even if that's to the detriment of the world. And I've been surprised, frankly, in talking with bankers, how many people think the America First of Trump ends at Basel. It doesn't touch the Financial Stability Board. I think that view is incorrect. I think it's all encompassing. So I think over the next few years, particularly led by the Treasury Department, more so than the independent bank regulators who are a little more bought in to the global system, but led by the Treasury Department, you're going to see in the White House, you're going to see an administration where America doesn't view its role as being a global financial regulatory leader, and instead views its world as advocating for its own narrow self-interest.
And that's going to be tough because we're talking more about collaboration and partnerships. For example, here at Sibos,
Correct. For example, a lot of the reason why the global financial system is underpinned, and this is why I disagree with the kind of core idea of America First, as the way that Trump puts it forward. I think a healthy and stable world is in America's best long-term interest. It has to do with that, but I think it'll also produce opportunities. It'll produce opportunities for other countries, for multinational organizations, for other collaboration of financial services players to take a lead where individual national governments are squabbling with each other. I mean, sometimes if government can't lead, industry has to.
How do you think the banks should prepare for it?
Well, I think the banks need to think about serving their customers, serving the economy, and serving their, the nature of their clients. Banks, I think, need to think of themselves as a means, not an end, right? They're providing a service. The finance is providing a service, connecting savers and investors and useful entrepreneurs and the useful remediation of capital, right? It's not a end unto itself finance. It's a means to connect people with money and people who need money. And I think if banks can internalize that and orient themselves in that way, they'll be poised to succeed in this new space.
All right, Aaron. Well, thanks for coming in and sharing that with us.
Thank you very much. Pleasure.
A very interesting conversation there. Well, let's leave the studio for a brief moment with a reminder of some of the great places to shop and eat in while you're around downtown Toronto. Take a look.
Yummy. Yorkville in Midtown is your first port of call if you want to splash out on some upscale shopping. If you're after a Canadian gift to take home, Drake General Store supports homegrown artists and designers. The Distillery District east of downtown is an essential stop. It's home to a mix of cafes and restaurants, eclectic shops and art galleries. Toronto is a real cosmopolitan mix with different neighbourhoods offering cuisine from all over the world. Set on a strip of College Street, buzzy Little Italy's main draw is its classic pizzerias, trattorias and gelato shops. In any city, Chinatown is always a place to visit, and Toronto doesn't disappoint. Ethnic Chinese from Hong Kong, Singapore, Taiwan and Vietnam run a vast selection of shops and fruit markets, and there's dozens of authentic restaurants to tempt your taste buds. If you'd like to use your Toronto key perks, try the Sultan's Tent, a French-Moroccan restaurant with belly dancing every night. After a few margaritas, maybe you'd like to join in the fun and give your hips a shakedown. Alternatively, the Epic at Fairmont Royal York offers fine dining with seasonal and sustainable ingredients. They even grow their own produce on the rooftop garden, 14 stories up. And be sure to try one of their delicious cocktails. Well, I hope that's given you plenty of ideas. The Sultan's Tent looks like a lot of fun. Are you going to go?
Okay. On my list of things to do. Well, we're joined now by Javier Perez-Tasso, Swiss Chief Executive for the Americas and UK region, and also the host executive for Sibos Toronto in Canada.
And he's going to be telling us how the financial industry is innovating to create the robust interbank payment infrastructure of the future. Welcome to Sibos TV, Javier. Great to have you back.
Yes.
Thank you.
Well, we heard yesterday at the opening plenary that technology, change and innovation high on the agenda. Does that resonate with what you're seeing across the financial centers that you manage?
Yes, definitely. I mean, we see it happening across the major financial centers. And actually, well, we all know the context, right? We've heard talk about the fourth industrial revolution, which is essentially an industrial interplay of technology, not just mobile and cloud, but also big data, sensors, robotics, DLT, AI, machine learning, just to name a few. And the thing is that it is really having now a major impact on the financial industry. And particularly because businesses expect from financial services the same kind of experience, choice, and service integration that they get in their daily lives from the so-called GAFA, the Google, Amazon, Facebook, and Apple. Well, one of the good things is that the industry is responding. Innovation is happening now. And yesterday, actually, in the opening plenary, well, it really came across with that evolution that the transaction banking model is having because of a series of new entrants, fintechs, niche players that are essentially kind of salami slicing the payments value chain and increasingly, by the way, powered by pro-competition regulations like PSD2 in Europe and leveraging new technologies like APIs on the back of open banking. And all of that is, yes, creating increased competition, but also a whole set of new partners that we're seeing here with increased collaboration between banks and fintechs.
Mm-hmm. So what do you think are the critical ingredients for success?
Ingredients for success? Well, I mean, this if you think about it, this front-end innovation that we're seeing now is very visible. We see it on the press on a regular basis. But it relies on an area that is much less visible, but I can tell you, as critical, and where there is a huge amount of innovation going on as well. Obviously, I'm talking about the underlying interbank financial infrastructure that needs to be resilient, scalable, and secure, and because it is essentially the foundation of all of this front-end innovation. And talking about ingredients for success for this underlying infrastructure, I would say I see essentially three. I mean, obviously, it needs to be innovative and allow for technologies to meet these new customer needs. It does obviously need to help the industry in meeting the very important regulatory requirements around financial crime compliance. And it does need to stay secure and resilient in meeting the cyber challenge. And when it comes, when we talk about renewing infrastructure, you all know, I mean, for any infrastructure, there are always two schools of thought. Either you start from scratch with essentially blank sheet of paper, or you evolve what you already have building on existing foundations. And that's exactly where the industry is at the moment.
And you've mentioned two approaches there, either starting from scratch or not. Yeah. So what are the advantages of each of those approaches?
Well, let's start with the starting from scratch. The advantages of those that start from scratch are obvious. I mean, they are unencumbered by legacy systems, and therefore they can deploy the latest technologies really fast. But what we're seeing so far this week is that you can really innovate leveraging existing infrastructure because there are tangible assets that the industry has already in place today. Assets such as strong governance, operational track record, resilience, security, and global reach. I mean, global reach, arguably I would say, the most critical success factor when it comes to any innovation, and payments infrastructure is not an exception. So that's why personally, I wouldn't throw out the baby with the bathwater necessarily here.
Mm-hmm. And in terms of the infrastructure you're talking about, are you seeing concrete examples of how it's developing?
Well, I can tell you a couple from the SWIFT perspective. One on cross-border payments, we are upgrading the existing correspondent banking rails to achieve same-day funds and end-to-end traceability and transparency of fees. Mainly keeping, and that's important, keeping banks front and center, allowing them to dramatically improve the cross-border end-to-end experience, payment experience to their corporate customers by exposing this data through APIs. So that's clearly one of the many initiatives. That's called Swift GPI, and I think you've heard about it so far this week. It's gaining very strong momentum. We have in excess of 2 million payments sent on GPI since its go-live date earlier in the year. And when we talk about speed, it's essentially much faster than 1 day in practice. Of course, the Swift bit is just a few seconds, but even end-to-end, we see a significant number of payments being credited to beneficiary parties in a matter of minutes. And while this service builds on existing rails, it doesn't mean that the service is static, as proven by the recent proof of concept that we launched on DLT for North-South account reconciliation to optimize liquidity. So that's one example. If you want another one, that's cross-border. Domestic. In domestic, we're supporting instant payment initiatives around the world by both reusing our interface technologies, but by also coming up with 24/7 low latency, high throughput network solutions that can be reused. But at the end of the day, I think what is important, and because one of the ultimate aims is to have this end-to-end visibility of the payment and end-to-end transparency, basically an end-to-end connectivity of these domestic payment systems, as many of those, if not most of those, are moving to ISO 20022 standards. The beauty of Swift GPI is that it can make the domestic payment systems interoperable.
Now, last year when you were on the show, you talked about cybersecurity, and you can't fail to notice it's still incredibly important this year for the Swift community in Canada and beyond. I mean, what's your reading of it?
Well, you said it. I mean, it's as important, if not more. It remains very critical. Let's put it that way. I mean, if you think about it, with all of this, while all of this innovation is going on, cybersecurity is keeping the industry's feet firmly on the ground. Because as banks keep rolling out new digital services, there is a growing number of entry points for cyber criminals to access systems and customer data. And yesterday at the opening, the cyber, a big issue debate, it came across that one of the approaches to fight against that is to have a cyber mindset from the outset when coming up with new products. Essentially, to design in cybersecurity when we are innovating. So we live in a world where I think the digital age is probably more than ever the age of risk management. And if I can make an analogy actually with the team sports, well, you know, I mean, you need to be very strong in the attack if you really want to win the game. You need to have essentially creative scorers that exploit opportunities. But you also, if you really want to win, you need to be incredibly strong in defense. And that's essentially the point here is, yes, very important to have a commercial attack, but as important, or if not more, to have a strong defense. And that's the balance where the industry is getting at.
Just checking, it's the most important game in the world, football you're talking about, or do you call it soccer?
Why don't we talk about hockey here? We're in Canada, right?
We're in Canada, and in any game you need the attack and defense, both, right?
No, but and maybe coming back to cyber, because we've been discussing before that, that over the past 12 months, and talking about 12 months, look at what has happened. It's not only the financial industry. It's we've seen attacks across many sectors. Black WannaCry, very good example. We've heard this week numbers that are pretty telling about the sophistication of the attacks. 6,500 new vulnerabilities, in excess of 120 million new pieces of malware, and getting hit is an expensive business. We know that. I mean, it's the average cost of a cyber attack is in the range of 2 million.
So
defense is as important as ever. Javier, thanks so much for coming and sharing
with us. And you've got parties to go to tonight as well.
Well, I want to talk about those.
Well, customers' expectations of financial services are rapidly changing because of user-friendly digital products like PayPal, Zero, and TurboTax.
So how can banks compete? Earlier, I spoke to Orimas Adamavicius, president of DevRich, and asked him what exactly is the digital transformation of a customer experience in banking.
Right. So if you think about how customers used to experience the bank previously, it used to be primarily through the branch, right? And in this day, the customers primarily interface, or at least the millennial group of customers, interfaces primarily through digital devices, mobile phones and internet and so on and so forth. And what's happening in the industry right now is that customer loyalties are very fickle because people want a great experience. They don't necessarily care about what's sitting behind that application that they're interfacing with. So what banks are facing is they need to transform their organizations to become digital product orgs instead of being kind of segregated into separate IT departments and design departments and marketing departments and then, banking departments and so on and so forth. So this transformation, this digital transformation and reorientation towards customer experience is creating that alignment inside the organization around the digital touch points that a customer experiences in their life cycle with a bank.
And is the challenge now in their approach to this transformation?
Right. So again, it's that structure, right? So the structure in any large institution is to kind of divide the institution by role within the organization. So keeping technology separate from the actual business people, and keeping design and marketing separate from the technology people. So that creates challenges because you end up having these waterfall delivery methods for shipping experiences to market. That's one of the biggest challenges.
And what sort of team do you think is needed to sort of help bridge that divide, to get that fixed?
Yeah, what we see and the trends and patterns that make banks successful is to adopt a product thinking mindset. So what that means is that the organization should use cross-functional teams to design and build digital products and take them to market. And what that means, it requires a transformation both at the leadership, of how leadership thinks around disciplines, and then also it requires a change in process and how execution happens at the team level, at the implementation level. So if you look at the actual disciplines, it's three. You have software engineering, which is kind of obvious for building digital, right? You have product management, which cares about what the product is, and then there's product design. And product design talks to the users, does customer interviews, user testing to influence how that customer experience is shaped in the mobile application or the website or so on. So you need to build product organizations that have all of those three disciplines in one cross-functional team, so they can work together and actually ship the experience to market.
And that really sounds like a challenge, because this day and age, very often we're specialized, working in silos to get that cross-functional teamwork going on. At the same time, finding out what really matters to the users on the ground.
Exactly.
Is that what you need as well? Someone testing it with users and...
Exactly. So the challenge again is that the institution and the bank has to start thinking about everything as, again, the cross-functional team is not just people from different departments working together. It's one team that reports up to a CDO, like the Chief Digital Officer or Chief Product Officer, whatever you want to call them. So one, it needs that reshaping, and then yes, you're right, that when you are actually shipping the product to market, the best way to do this is to have a couple of short iterations and ship an MVP to a customer and test with the customer, and then use those learnings to influence your product as it kind of evolves through different stages. So again, that is very uncommon for the classical delivery model right now, because banks typically, they build for a year and a half, big reveal, right? And then all of a sudden, then you need a course correction, which you've already exhausted the funds and not enough time to pivot, and so on and so forth.
Okay, so instead of waiting for the big reveal, actually midway the user testing should have taken place.
Exactly.
To find out.
Yeah, and I'm talking about moving at the speed of a fintech. And the whole idea is working like a startup inside the product organization and having these iterations where you ship product quickly and you validate it. And what that essentially leads to too is you're not afraid to fail, because your incremental piece of work is small, so a failure is not critical. It doesn't disrupt your delivery roadmap.
Okay. How can companies like DevBridge help banks with this kind of transformation?
Right. One is we obviously work on the delivery side in helping them build and ship these products to market. But what we see really is that to successfully perform a transformation, you need help from leadership to set some expectations, but then you need to implement the process and the practice at the execution level. And it's really hard to adopt a process and learn something without someone actually running in parallel to you. So what we do is we shape our cross-functional teams. We take our cross-functional teams and we pair them with teams at the bank. And so you essentially have an experienced delivery partner that's teaching, coaching along the way, as well as helping internal teams do delivery over time. And so that, talking historically, we've done work with multiple tier 1 banks, one actually here in Toronto, the CIBC, and we were able to help them ship a mobile experience to market in 6 months. That's from concept to delivery to market across 4 different mobile platforms. So again, it is possible, right? It is possible for large institutions to move rapidly, ship quickly, and be like a startup, be like a fintech.
But they'll be thinking, so then which parts should I keep in-house? Which parts should I delegate to partners like yourself?
Right, and very good question, right? And we always say that, product ownership and the domain expertise, understanding the customer, being close to the problem, that can't come from a partner like us. That has to come from the bank. That's why we think that a lot of large consultancies that try to help banks do things better from a customer standpoint are really not well positioned. The bank always has to come forth and they need to talk to their customers, they need to do testing and so on and own the product. And then delivery partners like us, we help them ship and get that practice rolling and bring the expertise around technology and design.
So what do you think is the biggest challenge right now for banks in this kind of transformation?
Yeah, there are a lot of challenges, I think. What I see is the tactical execution at the team level is getting better and better, and banks are being more and more successful. One challenge, or a couple of challenges, is one, most of these applications are still sitting on large monolithic platforms behind the scenes. And the other big challenge is that large institutions still do funding models based on linear delivery. It's still a business case that influences a product, and they're only based on the annual budget. So there's no vision of a product beyond a single year, for example, So it's tackling those two things, kind of trying to use a microservices strategy around the core banking platform, so you could essentially create a loose coupling between the front-end application, the customer applications, and your large monolithic systems behind the scenes. And then also working with leadership to come up with new innovative funding models where you fund business ideas like startups, where you give out small amounts of money, test the ideas, have them validate, fail, succeed, like a Shark Tank, right? And we know the popular show. So using that model to actually fund business initiatives inside a bank.
Okay. Well, thanks so much for coming and speaking with us.
Of course, no, thanks for having me.
Yeah.
Alrighty.
Well, Stephen, speaking as a consumer, I can't wait for all these easy-to-use, customer-friendly products.
Well, that's the day we're all looking to. It's also interesting to note that a lot of the innovation is coming from the smaller fintechs, and many of whom are here at Sibos.
Now, as we all know, banks are dealing with disruption to their traditional models in a highly competitive environment. But some are increasingly seeing rapidly advancing technologies like big data, artificial intelligence, and machine learning as an opportunity rather than a threat.
Well, earlier today, I met Umar Farouk, head of digital channels and innovation at JP Morgan, to find out how technology could actually give banks a competitive advantage. So I began by asking him, how are demands on banking from corporates changing?
I think the demands from corporates and banks are not very different than demands of customers on their providers in general. So customers have always wanted the same things. I think now that we move into the digital realm, many of the same things are more in the digital realm. So they're asking us to essentially do a few things for them. They want us to make them do their business better and focus on their work versus trying to focus on how to connect and how to transact and how to communicate with us. They want us to give them insights. So they don't want us to just give them data, but actually be able to extract value. And they want us to essentially provide more efficiencies. And they want us to do this in the digital realm increasingly so as time goes by.
So if I had to ask you which of these technologies are sort of out there helping them meet those expectations?
I think it's a broad range. We've basically picked a handful of technologies, I think about half a dozen or so, where we are actively investing in emerging tech. So these span everything from APIs, which have been quite common outside of banking, but now are coming to wholesale banking and retail banking quite aggressively, to blockchain, to data science, to machine learning, AI, cyber, etc. So we are very focused on them because I don't think it's any one technology or two technologies that are going to make the difference. It's going to be a combination of them.
And we know key to that is also the user experience.
Yes.
And you lead teams that deal with that. Sort of what kind of user experience are they looking for?
So I think it's two things. One is user experience and one is design. So historically, user experience has been more driven by consumer companies or even some of the tech providers who are on the West Coast. But increasingly, people are judging us against the experience they're getting on their cell phone. Mm-hmm. So you have to compete with a very different level of expectation. So we have now started building user experience teams that look at UI and UX in the context of mobile, in the context of web interfaces and so on. And at the same time, there's an increasing realization that design is key to building new products, which it's not so much as hearing what someone wants and go building it. Mm-hmm. Let's try to figure out what the need is and what's the best way we can actually go and satisfy the need.
So a few challenges there, but I mean, will these new technologies and these new products help improve that user experience?
I think dramatically so. So if you look at things like blockchain, they will offer both increasing efficiency, but also a very different level of experience, interaction, and product capability to the clients. And the same thing goes for UI UX. I mean, frankly, these are rapidly evolving spaces, and we are quite positive about all of them.
So should the banks be looking to develop their own, or just looking to others to help them and bring those services in?
So I think it's a combination of both, but it also depends on a bank's strategy. So if at our scale at JP Morgan, we can obviously afford to build a lot ourselves. We have quite significantly large and very highly trained technology teams, but if you're a smaller bank, that's a bit harder to do. But even at our scale, we realize that not everything is done best in a bank, and whether we go a utility route or we go and work with some of the emerging tech providers or some of the vendors, that's been a strategy of ours to actually have a portfolio of approaches versus one or the other.
Well, you said you had some investment. According to your annual report, JP Morgan has spent about $3 billion on technology initiatives. What are the key focus areas?
So actually it's about $3 billion is what we are spending on new stuff. We spend more than $9 billion overall in JP Morgan, which is frankly more than most tech companies do. But within the $3 billion on new stuff is really across our entire tech stack. So starting with the very core infrastructure. So for instance, we are heavily investing in redeveloping and sort of updating and frankly modernizing to cutting edge our payment platforms, our liquidity platforms, our securities platforms. So that's one sort of investment. We are similarly making investments at the front end, so rethinking our channels, customer interactions, building APIs, and sort of providing different front doors and much higher quality front doors for our clients to work with us. And then the third piece of technology investments are new technologies. So we are heavily invested in things like blockchain, data science, machine learning, APIs. So it's a combination of all of those things.
Well, artificial intelligence is one of those other areas that's been a bit of a buzzword lately.
Yeah.
And we know that's an area you're looking into as well. Which do you think has the most potential for JP Morgan?
So I think it has high potential, but I think artificial intelligence can be a bit misleading. It's actually a broad spectrum, and everything starting from a simple regression, which is many of us did in college or or in our early days in the job, all the way to AI is a pretty broad spectrum, and we are looking across the entire spectrum. I think our focus, and many places focus, is more in the machine learning, natural language processing, natural language generation space, where we can bring a lot of value to our clients. So I think that those technologies are frankly having more impact right now versus pure AI, which is still a little bit in the future for us.
Okay, how far away do you think though? Is that?
I mean, people have started talking about it and prototyping it, but now you're talking sort of Skynet type thing, so it'll take a little while for us to get there, and also for the banks, the customers, and the regulators to actually get comfortable when you cannot explain why a machine made a certain decision.
Right.
It's not easy to get to.
And of course, when you say get there, it means where it's almost seamless and it's part of our lives, right?
Exactly.
Yeah.
So.
JP Morgan's also been researching blockchain technology and potential use cases since 2014. Some of that's been done with the public in open source. Why choose open source?
So I think we were frankly the pioneers within the banking space in terms of open, in terms of blockchain technology. We started investing in blockchain, frankly, before most banks did. And what we realized was that we were trying to develop solutions at the same time that people were trying to develop platforms. So our choices were to wait, let someone else do it, or build our own, and we decided to go with the latter for obvious reasons. And we had the technical expertise, and we had some great people in JP Morgan who could do it. We built it, but fundamentally what we want to do is we want to focus on building apps and solutions for clients and trying to build products. We are not a platform building shop. We are not a big tech shop as such. So the best way to develop that platform is to have the open source community support us. So that's why we chose Ethereum, which is an open source platform itself, built on top of it, and actually contributed back to the community where, frankly, thousands and thousands of developers are now helping us upgrade the platform. So I think that's where a lot of the future value will be captured. That's where things like Linux, et cetera, have made so much progress, and that's the strategy we decided to pursue.
Can you share a few examples of the benefits that have come from working with the public and open source?
So I think from a security point of view, from a point of view of basically upgrading certain consensus mechanisms within blockchain, it's been very positive to have a broad community supporting it versus limiting it to a certain platform or a certain set of people who know how to operate that platform. So we are getting a lot of not only just halo effect, but actually direct uplift from the broader Ethereum community, from vendors who work with Ethereum. So we've seen a lot of positive things come out of it. I mean, we recently been working with zero knowledge proofs in certain areas, and all those things, frankly, wouldn't be possible without a platform as open as Quorum.
Okay, let's look ahead a little bit. Coming up in the next 12 months, which of the new product services you think that will be available to corporates because of technologies like the stuff we talk about, blockchain, artificial intelligence, machine learning?
So I think it's going to be both products and also efficiencies or experience improvements. So if you look at experience improvements, we announced something yesterday called the Interbank Information Network, which essentially reduces the friction when payments across the globe that are currently traveling on correspondent banking rails, they get flagged or they get stopped for inquiries. Could be for sanctions, could be for fraud, could be for other reasons. And these inquiries can take up to 2 weeks sometimes in the worst case scenario. And with deploying a blockchain solution, we can cut that time down to minutes or hours, but within a day. So that may not be a new product, but it delivers a great experience. At the same time, when we look at some of the asset sort of trading, markets type activities, there are products everyone's working on, which will probably create new markets. Again, we are probably 6 to 12 months away from that point at least, because most of the focus has been on the infrastructure, but we'll get there.
6 to 12 months isn't very far at all.
It's not very far, no.
But looking further ahead, let's say 2022, in about 5 years' time, how could corporate banking be different as a result of these technologies?
I think you'll see a much higher level of focus on automation, generally speaking. So whether that's through robotics, whether that's through blockchain, whether that's through using machine learning and AI, I think you will see a lot more focus on that. I think you will also see a lot more value being extracted from the data itself, which is, I think, an underutilized asset at this point across corporate banking in general, where we have reams and reams of data. We have lots of money moving through JP Morgan. Obviously, we are the biggest US dollar clearer by some margin. But our clients and we are probably not utilizing that data to the full extent that they could. So there'll be a lot more data products, a lot more efficiencies, and frankly, a lot more emphasis on straight-through processing and a much better quality of user experience.
Okay, so at the end of the day, the users will benefit because the experience is going to be really a lot better.
I think, frankly, without that, we couldn't really progress as a bank. We are starting everything from the client point of view, looking at their experience, what they want and what they need, and then building to that spec 5 years out.
Very quickly, I know you have a session coming up in a short while this afternoon. Give us a sneak preview of what people can expect.
So I think it's a session about fintechs, about big tech, and about banks. And I think the one thing I would say is and I might repeat this there as well, but I read this quote from someone saying people are good at magnitude or miracles. And I feel like fintechs are good at miracles and we are good at magnitude. So I think working together we can deliver both, which would be where you can create some true magic together.
Okay. If you can deliver a magnitude of miracles, there'll be many happy people. Uma, great talking to you.
Thank you. It's great talking to you too. Take care.
And that session will be as the financial services industry and fintechs work ever closer. Where does that leave big tech in conference room 4? That almost brings us to a close for Lunch with Sibos.
And earlier we heard from Jen Calvary and Nick Maxwell about the right information, governance and control required to tackle financial crime.
Well, to hear more, up next we have the future of financial intelligence sharing, the key to fighting financial crime. That's coming to you live from conference room 1.
So stay with Sibos TV. We'll see you at 3. Have a great afternoon.